Hello, everybody. Ed Yardeni here. I'm solo today. Eric's on vacation. He went to Mardi Gras, but not in New Orleans, in Trinidad. That should be an interesting experience. I'll ask him to send us pictures, see what kind of fun he's having. But anyways, he tells me this it's sunny and good weather, so we wish him lots of relaxation. Uh, it's hard to relax in these markets, obviously, when you've got Trump 2.0, when you got the president issuing executive orders almost daily, when you've got social uh, truth social or social truth, whatever his media is called, posting all sorts of updates on his latest thinking. Here we thought that Tuesday we're going to get 25% tariffs on Canada and Mexico. And over the weekend, one of the Trump officials said that it's fluid. So we'll see what happens, how fluid it will be on Tuesday. I heard or I read somewhere that Mexico has offered to slap tariffs on China comparable to the tariffs that we slap on China. So if I guess if Canada and Mexico come back to Trump and say, we'll join this North American bloc with the same tariffs with regards to China, then will you give up on the 25% tariff? So we'll see how that goes. And nothing is for sure. Nothing is permanent when it comes to Trump 2.0. So that creates obviously a lot of uncertainty. I still think at the end of the day, when all these things are negotiated out, that we might actually wind up with having lower tariffs with our trading partners rather than higher trading the higher tariffs. But we'll see how that plays out, obviously, in coming weeks. It may take several weeks, several months to see how everything settles down with Trump 2.0, if it ever settles down. But there could be some settling down of what the tariff situation is on a more permanent basis. And again, I think it might be lower rather than higher. I guess we're going to get some sort of resolution of the budget sometime in March. We'll see whether there'll be a government shutdown, as is often threatened, or whether there will actually be a deal. But clearly, Trump wants a big, beautiful deal. And let me just turn that off. So the tariff issue, the budget issues, hopefully there'll be some resolution that'll kind of calm the markets down. But there's always something new. I mean, we've got this over the weekend. The president said that he's now in favor of a crypto strategic fund rather than a reserve. The idea being that rather than just viewing all the bitcoins that the government has managed to acquire from illegal activities, others illegal activities, obviously, that they are going to sit on these bitcoins and watch them go up in value. But clearly, if we have a reserve fund in cryptocurrencies, and now they're talking about more than just Bitcoin, that would be something that the government could actually intervene in and provide a put. So I think we now actually do have a Trump crypto reserve put in effect, because we got down to 78,000 on Bitcoin on Friday morning. And then obviously with this announcement, the price of Bitcoin shot back up. And then on Friday, there's going to be some sort of conference at the White House on cryptocurrencies. And there's a lot of members of the Trump administration that are very pro-crypto. But I'm kind of wondering whether the Bitcoin proponents like this idea or not. Obviously, having a put is a convenient thing to have if you don't want to see the value of your Bitcoin and cryptocurrency portfolio go down. But having the government involved in a cryptocurrency that was invented with the idea that it would be independent of central banks. It would be independent of government institutions and officials. And now suddenly it's becoming very dependent on them, and the government becoming potentially a major player. Now we know that Michael Saylor has come up with this ingenious, maybe not, but possibly ingenious strategy for his company, which is now called Strategy. And the idea, of course, is to issue convertible bonds at 0% and use the money to buy Bitcoin. And there's only 21 million Bitcoins that can be issued all told by the Bitcoin program. So given that the supply is basically constrained, if Saylor can just keep issuing bonds and buy Bitcoin, driving the price of Bitcoin up, that drives the stock price up, and so on and so forth. This has become some very esoteric, popular trading tool for hedge funds that I don't quite understand, but there's clearly hedge funds are very much involved in a so-called volatility trade related to the way this financial structure of Strategy is created. But I would think that the real proponents of Bitcoin, the real believers, should be against having this currency leveraged up with these kind of games in the private sector. And we're hearing about more and more companies saying, hey, this is not a bad idea. Let's buy Bitcoin. As a matter of fact, the Financial Standards Accounting Board just recently ruled that companies can mark to market their Bitcoin holdings. And I think during the last quarter, the latest quarter for Tesla, that boosted the earnings of the company. Don't quote me because sometimes I forget these numbers, but I recall a number, something like $600 million was the appreciation that was included in Tesla's earnings. Now, of course, that could work both ways, but if you've got a Trump put on crypto, that creates a whole new ball game. So it's kind of crazy to think about where this could go. More and more companies buying Bitcoin, the price of Bitcoin being basically manipulated by the government. Could it be that Trump thinks that if the reserve becomes big enough that we could use that to pay off the debt? Imagine the day that that's announced, what that would do to cryptocurrencies. So it's all kind of head spinning kind of stuff, right? But it's not the only head spinning kind of stuff going on here. The other, of course, has been the impact of Trump 2.0 on the economy. And there's a lot of people who have concluded that animal spirits are being trumped by the uncertainty created by Trump 2.0. We're still hanging on to the idea that the economy is going to continue to prove to be remarkably resilient. Maybe we're overstaying our welcome here with this idea, but for the past 3 years, it was widely thought that there would be a recession because of the tightening of monetary policy. And we were alone or almost alone in thinking that the economy would be resilient, that there might be some rolling recessions, but the economy would grow. And we try to kind of learn from our experience. And so what we learned from the experience of the past 3 years is that we were right. The economy was resilient, and maybe the message is it'll continue to be remarkably resilient. And yet all these people who were wrong are now saying, well, here it is. We're now going to get our recession. We're not going to get our significant soft patch, not even a soft landing, just now they're talking about stagflation. And what will do that, of course, is that the economy is facing so much uncertainty on trade, on the immigration issue of sending people back home, and that these things will weaken the economy much more so than deregulation, tax cuts, because those still haven't been fully kicking in. But the combination of sending people back home, the impact of the Doge boys cutting back employment, that's all going to cause a much weaker economy. And so far, that idea has worked quite well in the bond market. The stock market has been very choppy of late. Again, there's concerns there, of course, and some of the data has been weak. Today, we were surprised that the purchasing managers for manufacturing was not as strong as we expected. It was still above 50 for the second month in a row. So we'll take that as an indication that the manufacturing sector is improving. But some of the regional surveys, five of the regional surveys collectively suggested there would be a stronger purchasing managers index. Well, I would counter all that by saying that the value of the PMI in assessing GDP, by the way, isn't all that great. The fact of the matter is GDP growth for goods, which has historically been highly correlated with the PMI for manufacturing, well, that correlation hasn't really been that strong. The PMI for manufacturing has been weak, below 50 now, except for the past 2 months, since late 2022. And yet the growth rate of real GDP goods has actually been solidly positive. So I kind of take that as some comfort here on this weaker than expected PMI for manufacturing. Now, how about the PMI for non-manufacturing that we're going to get on Wednesday? The market sold off, I think it peaked at an all-time record high on February 19th, not that long ago, and not that much higher than where we are now. But I think it was on a few days later, February 23rd maybe, that the S&P Global NMPMI came out, and it was surprisingly weak, and the market sold off on that news. And we pointed out, well, we're not really big fans of that indicator. We'd much rather look at the ISM National NMPMI, which will be out on Wednesday. But even that indicator really doesn't correlate all that well with GDP services. So we think GDP is going to be okay in the first quarter, 1.5%, 2.5%. Well, did we fall asleep at the switch there on Friday? Friday, we saw that the Atlanta Fed revised its GDP numbers for the first quarter from up 2.5% to minus 1.5%. And a lot of that had to do with Trump 2.0. And because of Trump 2.0, a lot of importers have been, oh, there he is. Well, no, that's actually Bailey. Anyways, with Trump 2.0, there's been a lot of uncertainty about tariffs. But if they're coming, might as well try to accelerate what you're going to get from overseas before the tariff is imposed. And so there's a huge increase in imports during January. And it turns out that I don't really know the numbers, but we're going to look for them. It turns out that a good chunk of those imports might have been actually gold imports, which left London and came to New York. I guess they were parked somewhere safe in New York, maybe not double parked. But at any event, so a lot of head spinning stuff going on here, and of course the consumer stayed home, particularly down south. It turned out that in January we had the coldest January since 1988, and so that, in my opinion, our opinion, undoubtedly depressed the consumer spending in January. So the Atlanta Fed, which just as a tracking model, lowered its number to minus 1.5%. We think that there's still the good news up ahead here. Retail sales should be up sharply in February, reflecting the reversal from the winter freeze in January. We think employment, which was up about 143,000 in January, because of the weather to a certain extent, will be up by 200,000. I think the expectations are like 180,000. So we think the data up ahead here will actually demonstrate that the economy is resilient. If we're wrong about that, we'll reconsider. But right now, that's where we stand. Let me show you a couple of charts here, which are relevant to the discussion we just had, if I can find them. Look at this correlation between the MPMI, the bar chart, and the year-over-year percent change in real GDP. It used to be a really, really close correlation. Not perfect, not always close, but pretty close. So the MPMI did actually have some useful content, useful information about what real GDP was doing. Real GDP comes out on a quarterly basis, and the MPMI comes out monthly. And look at this divergence here, where you had this very weak MPMI, and yet real GDP of goods was growing very solidly. As you can see, it's up 2.5% on a year-over-year basis through the fourth quarter. So that's just raising some questions about how useful that series actually is. But the markets obviously pay attention to it. The market also pays attention to the non-manufacturing. And here's a similar chart. We only have the data going back this far to about 2000, 1999, 2000, and you can see the correlation's okay, but it's not great. And so, how much really useful information do you get out of the NMPMI vis-a-vis what it means for the economy? The measure for February that I alluded to before was the S&P global measure, showed that it went down to 50. And so that was quite a startling decline. We'll see on Wednesday what the index does, but even if it's weaker than we're thinking, we'd argue that that's not necessarily going to be reflected in as weak a real GDP situation as people fear. Well, with that, I'm not going to go through the usual charts that Eric and I go through. I just really wanted to get these points across, and I think we cover that reasonably well. Why don't we get into a discussion here of some of the questions that you've put on the Q&A. And let me see who we've got here. See, Lee has got two questions. Okay. Seems to be bombarding the public with notions regarding inflation, job deterioration due to Doge, and any number of policies that are damaging the economy. Consumer confidence is reflecting this. Is our economy, I guess you meant the media, is bombarding us with everything that's going wrong with Trump 2.0. As our economy has maintained its resilience based on the consumer, how might these influences become self-fulfilling going forward, thereby offsetting the unshackling of the economy that is one of the mandates of the Trump administration? And then Lee follows that up with the media seems to be the first. Yeah, okay. So Lee said the media seems to be accentuating the negatives of everything that's going wrong. I think the media is obviously partly to blame, but let's face it, the data hasn't been great for a while. The retail sales report was down sharply, and that kind of started out the list of weaker than expected indicators. We know that the CESI, the Citigroup Economic Surprise Index, has turned negative over the past several days after having been positive. So now it's kind of as weak as it was during the summer of 2024 when we had a soft patch scare, and when the Fed responded to that soft patch scare by lowering the Fed funds rate by 100 basis points. So let's be objective here and say that the data has been weak, and the media clearly is looking for trouble to accentuate the negatives. That gets more coverage than that, I suppose. And it's conceivable that it'll be self-fulfilling, but let's see. I mean, the consumer confidence measures also haven't been all that reliable. I've often joked that when Americans are happy, they spend money, and when they're depressed, they spend even more money. So I'm not ready to give up on the consumer. I'm not ready to conclude that the consumer confidence indexes are all that reliable. We know that the consumer sentiment index is very heavily weighted towards sentiments about inflation, and we did see inflationary expectations jump in February. And I think some of that had to do with all the news stories about how Trump tariffs are going to increase inflation. And I think on a one-shot basis, it's reasonable to think that they might. Warren Buffett has pointed out that tariffs are taxes on goods, and somebody's going to have to pay it. And it might be the consumer if the prices of these goods go up. So there's certainly some issues there that are concerning to the consumer. Whether they'll cut back will depend really on employment and on the savings rate. And we did see that the January personal income rose quite a bit, but because of the weather, we think the savings rate also rose. So we thinking February, March data, which we're about to get, will confirm that the weather had a lot to do with it, just the way the weather had something to do with the soft landing, soft patch, I should say, that we had last summer. So I think the resilience issue relates to the resilience of the economy to deal with what seems to be bad news or the accentuating the bad news by the media. That turns out that the consumer, in their wisdom, realizes is not really the way the economy is behaving. So let's see what employment looks like. Look, initial claims did also go up just this last week, and that had clearly something to do with the Doge boys cutting employment at the federal government. So that's going to have some impact on the employment numbers. But I think a lot of us are going to be looking at private sector employment and finding that it's still pretty strong. Okay, Cactus. Thank you. Cactus says, I look very smart. I was just on CNBC and I forgot to take my tie off. Anyways, two questions, please. What's the true stock market positioning here in your view? Some sentiment surveys suggest underweight, others overweight. I think the answer is everything is kind of up in the air and confused and confusing. We've got sentiment indicators that are all over the place, but to a large extent, they've turned more bearish, which I guess is a positive, is bullish from a contrarian standpoint. To the extent that the stock market has been discounting the possibility of a stagflationary environment. In other words, that the economy is going to be structurally weaker here because the negatives of Trump 2.0 will outweigh the positives of Trump 2.0, particularly the tariff issue. I think if we wake up tomorrow morning and find that the tariff situation with Canada and Mexico is in fact fluid and that it's been postponed again, or it's been reduced because Canada and Mexico have joined us in a block of higher tariffs against the Chinese. That could change sentiment around pretty quickly. That's the problem we have in the current situation is we're very dependent on Trump 2.0's pronouncements and how they're impacting the economy and how they might impact the economy. But I think to the extent that some of the weakness reflects in the market reflects weakness in the economic indicators, if we're right, and so far we weren't right about the PMI this morning, but we discussed that. But if we're right about some of the other indicators up ahead here and the CESI starts moving back into positive territory, the Citigroup Economic Surprise Index starts moving up into positive territory, then we think that could be a positive for the market. We still think the market wants to go up on AI, particularly in the technology sector. But right now, concerns about a weaker economy have weighed on it. And the bond market, of course, we've been thinking 4.5% plus minus 25 basis points. Well, last I looked, we were at 4.2%, so we're below our range. We got above our range a few weeks ago. I think we got to 4.81 and then came right back down into the range. Now we're below it. So maybe the range is a little wider than we expected. But we think the bond yield will be going up back into the range. Andy, on the point around gold imports and noting the point in today's morning briefing around imports being subtracted from GDP based on the idea that they're already reflected in consumption, would these gold imports not be subtracted or would they still be? And if they are, would GDP take an unwarranted hit from that subtraction? Yeah, I think gold imports count as imports, period. If you look at the advance report on trade, which is what came out last week, on Friday, and that's what caused the Atlanta Fed to lower their numbers. And they're pretty good at tracking the numbers and what they imply for GDP. Gold import counts as a gold import, counts as an import. It would be subtracted from GDP, and would it have contributed to the arithmetic weakness in GDP. Gary, the correlation between PMI and GDP sure looks like we are turning down. Maybe the Atlanta Fed is onto something. I don't know. I mean, I looked at the same thing. We both looked at it together just now, and I'm not seeing what you're saying. Let's have another look. Then again, my eyesight isn't as good as it used to be, but I'm looking at this thing, and looking at. Let's make it bigger. Hopefully, I don't get into that game that I was just playing with my touchy-feely monitor. But you can see real GDP growth for goods. This is goods. Uh, you would think it would have been negative given its correlation with historical correlation with MPMI, but the correlation isn't perfect. It wasn't great in the past, but it was reasonably good, and I don't think it's particularly good right now. And so it looks to me like real GDP is doing just fine on the good side. So that's the way I'm looking at it. Um, okay. I don't know if that satisfied you, but let's move on here. Gary, Atlanta Fed. Okay, we talked about that. Um, Trump seems much less focused on the stock market this go round. Is the Trump put gone? Well, I mean, we now have the Trump put on crypto, and there's a really strong correlation between the price of Bitcoin and TQQQ, the highly leveraged uh, triple Q's ETF. And so, in an indirect way, that's a Trump put for the stock market, it would seem. If you get more NASDAQ companies, I mean, Tesla's already in there, Strategy's already in there. If you get, and I'm going to provide you with a link that'll allow you to track which companies are buying Bitcoin as a strategy, in their treasury portfolios. You could argue that if more companies decide to buy some Bitcoin and they're in the Nasdaq, then providing a Bitcoin put by having a strategic reserve, in effect, provides a put for risk-on strategies, including TQQQ, which then has a positive impact on the market. But on the other hand, to not be so convoluted about it, let's face it. Trump could start talking about the stock market today or tomorrow. If again, if we tomorrow wake up and see that something has been postponed on the Canada and Mexico, or some agreement has been made, the stock market would go up on that, and Trump would undoubtedly mention that this market likes what he's doing and the way he's doing it. So I don't see that just because he hasn't mentioned it, that the Trump put isn't there. I mean, he's got to do things. He can't just say the market's down and it shouldn't be down and the market will go up. I think even he realizes that he doesn't have that kind of magic power. Okay, William, it seems to me that the Trump-Vance tag team, while alarming, accomplished their goal by forcing Starmer's hand. If you do not know who the patsy is, you're the patsy. What am I missing? I've done my best here not to get embroiled into the Friday broiling that occurred in the White House. Usually deal making is kind of like watching legislation being made. I think Winston Churchill said it's like watching sausage being made. It's not you wouldn't want to eat sausage if you see how it's being made. It's pretty nasty and ugly. And I think legislation and wheeling and dealing is kind of the same thing. It's probably best done behind closed doors. It's best not to see it. There's a lot of one-upsmanship that goes on. There's a lot of screaming that goes on. But at the end of the day, the idea is to get a deal, and usually deals turn out to benefit both parties, or they don't. Both parties feel that they aren't losing as much as they're gaining. So I think there was a lot of public deal making going on Friday, and I think you make a good point that basically the Trump administration is trying to let the Europeans know that we're not going to be all that reliable when it comes to defending them against Russia. The problem is when you do that publicly, you're also telling the Russians that we're not going to be all that reliable to defend the Europeans. So the Europeans are scrambling here, I think, to recognize this new reality, and without really knowing, what will it take for them to show that they seriously have a stake in defending themselves, and will that be enough to bring the United States back into a more positive attitude towards NATO, towards Europe? So again, there's a lot of noise going on here, a lot of uncertainty going on here. I'm trying to stick with what I think we know, and I think what we know is the economy has demonstrated its resilience and will probably continue to do so, and that there's some really good companies that have come up with great earnings and great technologies and are increasing productivity. It's the old theme I've said before to you folks, and that is just kind of as a mantra, repeat to yourself, isn't it amazing how well the economy and the stock market have done over the years, notwithstanding Washington? So I'm going to leave you with a happy thought. Eric will be back with me. I've kind of gotten used to Eric and having the two of us working with you. So I hope I got some points across with just me doing it. At any rate, have a good week. Get a neck brace. Try not to get too dizzy from all of this. Try to stay as focused as you can on what matters. And that's not an easy thing to do. I'll admit that, but we'll do what we can to help you do that. Thank you.